From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the Fed allowing regulatory relief to expire. Treasury yields climbing for 7 straight weeks as Chair Powell pledges to look past higher inflation. We begin with the big issue, just how much oxygen is left in the Treasury sell-off.
Look at where bond yields are now.
The markets are worried about how high Treasury yields could go.
Can we go higher?
I think that's really is a key question for investors.
2%, 2.25% doesn't seem unreasonable.
Certainly still 2% could be in play, maybe 2.5%.
Expect the curve to steepen.
You've had a big move.
You're going to see 10-year rate forecast back up.
We have not even begun the process of reopening.
The 10-year yield could get as high as, say, 2.5%.
March is the month of capitulation trade.
In terms of absolute levels, they're not to worry about.
It's not about the level of rates.
Given how quickly the economy is recovering.
It's what happens to financial conditions.
What the Fed was trying to say to us
is a green light for the steepener.
A green light for the steepener, and that's what we got. Joining us to discuss is Manulife's Francis Donald, PGIM's Robert TIpp, and Kathy Jones at Charles Schwab. Francis, let's start with you, and a question I know you're pondering, and I think it's an important one. Just where did the additional upside surprises come from here on out, given where expectations are set currently?
Well, that's exactly it. What's the good news that isn't priced into the market? I don't think it's the reopening. It can't be China. China is already showing some weakness. It can't be more stimulus. The Fed has told us we're probably not getting yield curve control or extending that weighted average maturity. Is it more fiscal policy? Maybe. But is it the nature that we want? It's probably more redistributive, taxes ahead. We're going to need some really good news that we don't already know about, and it can't be about the reopening or the virus or more stimulus ahead. It's going to have to be something else, or else I think we're probably stuck in a range-bound environment. And even though we could see yields push higher for a variety of reasons, it won't be on good macro.
What are your thoughts on that, Kathy?
Yeah, I would tend to agree. I think we're probably going to consolidate around this level because we have discounted a lot of very optimistic scenarios in terms of the economy, and we've priced in somewhat higher inflation rate. I do think the direction of travel is higher, and we'll probably get up towards a 2% region if the economy continues to make progress going forward this year.
That's the issue that we have right now, Robert. For bond investors, you've got to look beyond the boom this year. You've got to think about the deceleration from 21 to 22 to 23 and beyond. Robert, how do you approach that thinking right now, that issue?
Yeah, well, so far, thinking ahead, Jonathan, has been exactly the wrong approach. This market is entirely focused on the current trajectory of the economy and is completely discounting any reversion back towards the kind of economy that existed before COVID, as far as I can tell. So I think the next shoe to drop, maybe the last shoe to drop, will be when this round of checks hits. So obviously we've had a big increase in yields. I think that we have clearly overshot fair value. For a number of reasons that we can go into. But can yields go higher? They can. And, if these checks are disproportionately spent, investors could find that very concerning, especially since, as was pointed out to the Fed on Wednesday, they're unique as a central bank in not caring where long-term interest rates are. That's been their posture. They avoided that. And the market may, test them further, unfortunately.
Yeah, I think this is one of the most important calls you've got to make right now for the U.S. economy, Francis, and I'd love your views on it. Where the savings go, how the checks get spent, and the difference between one estimate and another can be the difference between 5% GDP growth and something north of 7%. What are your thoughts on that one particular variable for this year for the U.S. economy?
How funny that economists actually hope that consumers don't spend their checks because we don't want to see too much overheating or pull forward.
Yeah.
But I hear a lot, are they going to save or are they going to spend? But the number that I care about is actually how much gets used towards deleveraging or paying down debt. We know from 2008 what deleveraging does. Ultimately strengthens the economy over time. But I've seen surveys that tell us up to 30% of those checks are being used to delever. Very good for the long term, but deleveraging is not inflationary. Deleveraging does not increase growth over time. So what I say to everybody is don't tell me how much they're spending, how much they're saving. Tell me how much is going into deleveraging, because that's the key to my outlook.
So what is your outlook right now, Francis? Let's put a number on it. The Federal Reserve's at 6.5% GDP 21. What are you looking for?
Yeah, I'm at 6.5% to 7%. And guess what? It doesn't matter. Nobody I work with cares what my GDP forecast really is. We care about what the Fed is going to do.
Yep.
We care about Washington is going to do. A lot of my colleagues here on this panel talking about that long-term rate. To me, the most interesting part of the curve is the 30-year. And it's the one that's least impacted by the Fed and most by issuance. So 240 was a key level. We've gone through that. I want to see if it holds. Where I think we may not need to start paying attention is actually on this concept of short cycle versus long cycle. We've talked about how much good news is in the price. Do we hit a fiscal cliff in 2023? Do we use up all of our enthusiasm in 2021 and 22 and then see consumption peter out? Or do animal spirits catch on? And I think it's been well pointed out, rates are not going to trade on that in the next 6 weeks, which is going to gather all the headlines. But if you're a long-term asset allocator like I am, that story is increasingly relevant.
Robert touched on that, so let's build on it. Kathy, it's about the future. It's about beyond 21, 22, 23. And the Federal Reserve for 23 is at 2.2% GDP, core PCE at 2.1. We're talking about back to trend, but to Robert's point, no one's talking about it. To Francis's point right now, no one's really thinking about that. What does trend growth look like beyond the boom times? What does it look like, Kathy?
Well, it's not just trend growth, but trend inflation. So, I think that there's been such a big shift in the focus of fiscal policy and the focus of monetary policy here that we're in a place that we haven't been in 40 years in terms of this coordination and the focus of those policies. So this fiscal stimulus is going predominantly into lower income households, into places like state and local governments to get employment back. And the commitment from this administration seems to be to push forward in that regard rather than tax cuts, et cetera. So that combined with the Fed that's really willing to push the envelope on inflation could mean that we have a dynamic that we haven't seen for quite some time. And that's what tends to make me think that, we're going to look at longer term yields continuing to move up. That reversion down to that very slow growth rate may not occur as the market really is assuming it will.
The 246 right now on 30s on 10s 172. We had Steve Major of HSBC join us in the last week, and he's talking about that reopening dynamic, the strong tailwind for higher yields, and then the secular forces that act as a headwind for Treasury yields over time. And Robert TIpp, you're the perfect guest to talk about this. This is something you've been thinking about for years and years and years now. And I want to know whether you and the team over at PGIM have been adding duration as 10-year yields have backed up this week, as 30-year yields have backed up again.
This is going to be the quarter. I don't think it's going to be a 2022, 2023 slowdown story. I think as soon as these checks are out and they're spent, you're going to begin to see the numbers go into retrograde. And so by the time you're in the third quarter, the fourth quarter, you're going to see sequentially your retail sales numbers are probably going to be falling back. You may have a boost from reopening, but there's a lot of economic activity going on right now. And the CPI numbers have been incredibly contained, right? So your last 6 months, I think your core CPI is averaging about 0.1%. So, and I think that, you had a few high inflation prints before the last 6 months, but I think those were, in the Lysol, lockdown stage of this thing when you couldn't buy a bottle of rubbing alcohol. But that's behind us. So I think that we're in that peak zone. We need to see yields, crest here. And I don't think you can get too carried away until you see the market's reaction to the next round of spending.
Yep.
But like I said, I think we've clearly overshot fundamental value, and this next 3 months is going to be that blow-off phase.
Francis, let's finish on that point in just this particular segment. I think this is probably the most interesting part the next couple of months, is that most people all agree on what the data is going to look like. What we can't agree on is how the market reacts to it. How do you think the market does respond to this? And this feels like a psychological question right now, and not an economic one.
It's not an economic one, because we can show you in just about any model that we are going to get CPI over 3%, and then it's going to call back to 2 to 2.5%. What I can't get my head around, if we're playing market psychologist here, is why does the market not believe the Fed when the Fed says it wants to overshoot and it's not going to tighten in response to this temporary increase in inflation? Why do we keep hearing the narrative that the Fed is going to be tested by 3% CPI, when Chair Powell is laying the framework, and their own projections tell us that they think inflation comes back. The most important element of Powell's meeting on Wednesday was that they incorporated the fiscal stimulus checks, and their 2022 and 2023 growth and inflation numbers barely budged. What they're telling you is that fiscal is short term and they're going to be looking through a lot. So what I want to know, the people who really have to go through the therapist, is this bond market who doesn't believe the Fed. The Fed has to do something about that, or the market has to concede. It's going to be one or the others.
Yeah, that tug of war is going to play out in the next couple of months, that's for sure, Kathy. Just a final word on that, Kathy. Why do you think there are still so many people that just don't buy the Fed? It's in the numbers now. It's in the forecast. They're telling us what they've been telling us for the last 9 months, and still there's people out there saying no.
Perhaps there are a lot of people who don't believe the Fed's forecast. So in other words, if the Fed stays ultra easy and inflation does outperform expectations and they sit on the sidelines, does it become embedded? What's the multiplier effect of all this stimulus? Is the neutral rate of growth being, miscalculated again, this time too low instead of too high? I think it's not just about not believing the Fed or wanting to test the Fed. I think the idea is that if the Fed follows through on what it intends to do and let the economy run hot, market has to build in some compensation for the risk that they're wrong about inflation and growth.
Kathy, really good point. Alongside Francis Donald and Robert Tipp, you'll be sticking with us. Coming up on the programme, the auction block. The US junk bond market close to setting a new record for March debt sales. That conversation up next, and we will talk about the SLR very briefly in just a moment. From New York City, this is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with the continent recording its busiest week since January. 27 issuers selling 20 billion euros in new debt, putting 2021 sales just 5% behind last year's pace. In the United States, Charles Schwab tapping the market twice in 2 days, helping high-grade debt sales top dealer estimates despite the sell-off in Treasury markets, and the volatility doing little to slow down the high-yield debt markets. Monthly sales now within $2 billion of the previous March record. Back with us, I'm pleased to say, is Francis Donald, Robert Tipp and Kathy Jones. I want to start with a story we were anticipating in fixed income for the last several months, Francis, and it was the supplementary leverage ratio and the exemption expiring month end. It will expire. Hasn't seen a big move in the bond market to close out the week. What was your take on that decision over at the Fed?
Yeah, you're right. We've been talking about it for about a month, trying to disaggregate. Has the move higher in rates really been driven by just the reopening? And as several of the Fed members have said, just all good things. That's the reason that rates are moving. And of course, we could disaggregate and show you that no, it hasn't all been the reflation thesis. Otherwise, the move wouldn't be driven by real rates. Some of it is bringing forward Fed expectations. And some of it, I think Kathy made a really good point before the break, that this market simply thinks that there's more inflation in the system than a lot of what the Fed is telling us. That's a really key point. The SLR has been one of the reasons we've seen one of this big drives up and has created a lot of volatility. But by the time the decision came to buy today, we'd already expected that banks had positioned towards it. And that's why I think we haven't seen as much of a move today. What worries me on a go-forward basis, I'd love to hear from the other panelists on this as well, is does this actually suppress demand on a go-forward basis as well? And therefore, are we really not looking for a one-day impact, but a multiple week or month impact?
Kathy, what's your take on that?
Yeah, I think it's a good question. We did get a few offsetting indications from the Fed where they're revisiting this topic. You've got the RRP, the expansion of the RRP, reverse repo, to create a little bit of space at the short end. So I think that this is something that gets addressed over time. And frankly, as Francis said, a lot of it was already discounted by the market. So I don't think that over the long run, this is going to be a long-lasting impact. But this is a tough one to parse out because there's so many different pieces to the puzzle on this.
Robert, can you make sense of that puzzle?
Yeah, I think that in terms of the level of yields, that's not the problem with the SLR. The problem with this is that it impairs liquidity. It basically takes risk-free investments on dealer balance sheets and charges them a premium for that. And what we saw in March of last year and what you see during times of crisis is that people need to be able to borrow and lend these securities, repo them in order to keep the derivatives markets efficient. And this is something that looks like you're disciplining the banks, and you want to have discipline. You want to make sure they're safe. This is not the place to begin, and it's not the time to begin in our view. But it's not going to impact the level of rates, but it impairs market function, on the margin. And so I think it's unfortunate.
So, Robert, does that lead to additional volatility? Does it exacerbate volatility? Does it lead to gappier markets? What are you looking for?
Yeah, so that's right. It does, in the sense that, when futures become mispriced and people want to arbitrage the relationships between different Treasury issues, between futures and Treasuries, having these kinds of constraints on the risk-free parts of this, that impairs it. So then, that ends up manifesting itself in decreased market liquidity, which is, over the years become increasingly a problem. That in times of stress, liquidity dries up, and charging people for bulk on their balance sheet that's riskless is not a sensible way to contribute to the market. It's a detracting factor.
I caught up with Priya Misra of TD Securities as this news broke. She came on the phone with us just minutes after the headline crossed the Bloomberg. And one thing she raised was what would happen down the road with issuance, with supply, Francis. And next week we get another test. We're back to that 7-year note story after that really ugly auction several weeks back. We'll get $62 billion worth. Is that a stress point? You expect some of these factors to maybe show up in the next several weeks?
Yeah, absolutely. We're watching for a host of issues. We're watching for, does the move up in yields start to impact things like housing activity, financial conditions, as been mentioned, but we're also watching that market function component. And that's probably the one that worries me the most over the next couple of weeks as we move forward. I also think that we're going to have to see a lot more problems before we see the Federal Reserve actually create some form of action to calm rates here. And market functioning, or signs that there are market functioning problems, is going to be one of them. And ultimately, the Fed has 3 sets of policy tools. They had their emergency policy tools like the 13.3 programs and SLR. Those are being phased out. And what the Fed's going to have to do is communicate with us that that doesn't mean that they're that close to tapering, or that tapering is not the same thing as raising rates. I think, as Robert mentioned, they're going to have to disaggregate the difference between some of these programs and the level in rates. And until they do that, there's going to be a lot of concern and volatility and nervousness in this market.
Kathy, I want to give you the final word on these issues. The final word, please.
Yeah, I'm getting a sense of deja vu because it was a year ago in March when we got the problems in the repo market and the liquidity disappeared. So I do think I agree with both Bob and with Francis that they're going to have to walk pretty carefully around this issue of liquidity.
Kathy, Robert, Francis, sticking with us. Coming up on the programme, still ahead. The week ahead, the final spread. Coming up, Chairman Powell and Secretary Yellen preparing their first joint Congress appearance. Looking forward to that conversation. It comes up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up in the week ahead, the BIS holding its Innovation Summit on Monday with Christine Lagarde, Andrew Bailey and Jay Powell all speaking. The Fed chairman then heading to Capitol Hill with Secretary Yellen testifying before Congress on Tuesday and Wednesday, plus a tenor Fed speak through the week. We get Fed Vice Chairman Richard Clarida on Thursday and more, and U.S. personal income and spending numbers coming on Friday. To close out the conversation today, I'm pleased to say Francis Donald, Robert Tipp, Kathy Jones still with us. Chair Powell, in an op-ed in the Wall Street Journal, I have to say a very vanilla piece, he said the following to conclude: the recovery is far from complete. So at the Fed, we will continue to provide the economy with the support that it needs for as long as it takes. I truly believe that we will emerge from this crisis stronger and better, as we have done so often before. Kathy, we'll hear from the chairman 3 times next week. Is there anything left for him to say?
Yeah, that's a great question. I'm not really sure. I think the mission next week for Powell is simply to calm people down, to reiterate the Fed's stance, and probably provide a sense that, yes, we're on it. We know all these issues are out there in the market, and we're monitoring them, we're on top of them, and we're in charge here. I think that's the message that he wants to send.
What's left, Francis?
Oh, I'm with Kathy. Just repeat it, say it 1,000 times, get that front end anchored. That's the most important story here. Maybe you'd like to see some of those rate hikes taken out of 2023, but for now, it's hold the line. I would love to hear a little bit more about average inflation targeting, how he's going to look through inflation in the next year. That might be pretty helpful. But if he just repeats it 1,200 times, that might be the most effective thing he can do right now.
What about you, Robert? He's done it 1,200 times already, and some people still don't buy it.
Yeah, it's really tough. I mean, in some respects, the sell-off that we're seeing in the bond market is the bond market believing them, that they will keep the rates low, they will let the economy run hot, they will exceed the inflation target. I mean, 5-year break evens and at the 260 area, it's very unusual. It's very unusual for break evens to be above an average level of inflation, which is like 2% on the CPI. But right now the CPI is running well below that. So this is a huge spread. It's a huge buy-in from the market that they actually will keep the rates low. And so he's, got himself in a bind where they're buying a lot of securities, but they've, worked against their own activities by saying, effectively that interest rates are low, financial conditions are easy if spreads are tight and if equity markets are high. And they've just, they're working against themselves, and I don't think they're going to be willing to change that narrative.
We've pushed back on this program on the same issue, Robert, that right now this market isn't really testing the Fed's credibility. That will begin if we start to see really strong data prints and the front end starts to sell off on, say, the 2-year. And so far, that front end's been pretty anchored. Guys, let's wrap things up quickly and get to the rapid fire round. 3 quick questions, 3 quick answers. Here's the first one. 175, the print on a 10-year this week. Where's your next 25 basis points coming from? Higher or lower? Higher or lower, Francis?
Oh, lower than higher again.
Kathy?
Higher.
Okay.
Robert?
Near term higher, longer term lower.
Okay, first rate hike, 22, 23, 24, or low for a whole lot longer. Final one, Kathy?
23.
Francis?
24.
Robert?
24 or later.
Keep running out of time on this program to get a third one in. Guys, great to catch up. Really good to see you. This was Bloomberg Real Yield. This is Bloomberg TV.